85.55.
22 seconds away from the opening bell in New York City this morning. Good morning to you all. Here's the price action. Equities up 16, advancing a third of 1% on the S&P. All-time highs in sight. Your Nasdaq up 25, advancing around about a tenth of 1%. There's the opening bell. Switch on the board and get to the bond market. 10-year Treasury yield shaping up as follows. Yields high yesterday, higher again this morning at 4 or 5 basis points to 167.17 on 10s. The dollar has been a whole lot stronger recently, particularly against the Japanese yen. Dollar yen through 116, euro dollar back through 113, down to 112.82. Negative there, a little more than a tenth of 1%. This is what happens when you take your jacket off at Bloomberg TV, because it's too hot. The boss comes over and tells you to put it back on and brings you a desk fan. A desk fan that I can't plug in, but apparently this is the solution. Is this going to work for you, Matt? I don't think it's going to work for me. Okay, never mind. From the Fed to the pandemic, a number of question marks spilling over into the new year. Despite all of it, investors still expecting solid results from corporate America in
2021, you saw very strong earnings really across the board.
The stock market is, of course, saying, hey, we're going to have high nominal growth, we have high real growth, we have high inflation. That should be good for earnings. That should be good for profitability in 2022.
We have about a 10 to 15% earnings growth rate.
It shouldn't take much for a little bit more multiple stability and continued strong demand on the top line for companies to deliver a year that's pretty strong.
An incredible fundamental story of growth and earnings.
Jonathan Gulliver, Credit Suisse, expecting earnings growth to fuel another 9% upside for stocks this year, running the following. Revenue and EPS beats have been running well above pre-COVID trends, supporting further upside to consensus estimates. And I'm pleased to say we have established a connection with Jonathan Gulliver. He joins us over the phone from Credit Suisse. John, let's start right there. You're optimistic, 5,200 year-end. Let's go from the top. Why, John?
Well, the most important thing is that, the consensus expectation among Wall Street economists is that we're going to have a fantastic year when measured in nominal GDP, and that's the key. So expectations are for something like 7.5% nominal growth. That's growth the way that you and I measure it, by the money that shows up in our pockets, and that's about 2 times faster than we would have in a normal year, let's say over the last decade. So that's the most important. And I think that people make this mistake that when they see inflation, they see higher expenses for companies and margin pressure. In reality, that inflation also shows up in higher revenues and higher profits.
John, you see margin upside, though, and that's what I think is interesting about this call. Where you see margin upside this year, where do you think that's concentrated? Is it concentrated, John, or is it broad-based?
No, it actually is pretty concentrated. So if we break the market into kind of big baskets, the cyclical stocks, think about energy companies, materials companies, metal and mining, even industrials and discretionary, retailers. Those areas have real big potential upside in their selling prices. They benefit from the fact that they have lots of fixed overhead. Think about like a mall retailer. They've already paid their rent whether 1 customer shows up or 100 shows up. So those areas with lots of fixed overhead are going to see the most margin upside. Where you're not going to see margin upside, and surprisingly, is not in tech. They don't have, they're just not as economically sensitive. They don't move with commodity prices, and so they'll be fine. They're just not going to be as good.
John, one thing you and I have worked on over the years as we've seen breakout in Treasury yields after breakout in Treasury yields, then yields back lower again, it's just this relationship between the bond market and valuations in the equity market. John, you've produced a fantastic body of work on that over the years. Here we are with the S&P 500 at an intraday all-time high, 10-year yields breaking out again. What's the relationship you expect this year, John, between the bond market and between equities?
Well, I mean, the most important thing right now is that the cost, that not only are interest rates low, not like when you're talking about interest rates, Jonathan, you're talking about the Treasury, with the government, with their borrowing rate is the corporations borrow at a higher rate than the government, and they pay a spread above what the government has to pay. That spread, that penalty that corporations have to pay because they're not the U.S. government, is incredibly small right now. So corporate borrowing rates are even lower than would be indicated by the Treasury yields that you're talking about. So that's the most important thing. And if you look at other periods where we've had PE multiples as high as we are now, and they're high, the borrowing costs were much higher then. So we're really in this incredible period of heightened inflation and really low borrowing costs. Heightened inflation is a boost to profits, and normally that would then be a penalty on the value of companies, but it's just not showing up in interest rates. You're getting a win on both sides. A win on valuations from low rates, a win on profits from inflation.
John, when we talk about the Fed through the year, I wonder what your playbook's going to be. I hear a couple of different terms used to describe what the Federal Reserve is going to do. A removal of accommodation, or the Fed is tightening. Now, I think that's beyond just semantics. You can have a deeply negative real interest rate that drifts higher but remains negative. That's removing accommodation, but ultimately is not tightening. So, John, I'm trying to understand from your perspective, when you think that Federal Reserve policy becomes restrictive, what does that look like in real terms for the Federal Reserve?
Yeah, and, if I were to tell you that we had, roughly 7% CPI, consumer inflation, and 10% or so from producer inflation, that's the inflation that companies are seeing, and then 12% inflation on imported products, which is what we're experiencing. And I said, okay, what would be the appropriate Fed policy for that? You would say that the rate should be 5 or 6%, some like really high number. So, when people talk about the Fed no longer buying assets, no longer doing QE, that's just saying that there's no longer putting more kerosene on this burning fire. If they even raise rates 2 or 3 or 4 times and they get to 1% on Fed funds, is that really restrictive, considering that we're going to run the economy at 2 times the pace of what's been historically average? So it's almost anything the Fed does this year, we're going to end up with policy that's going to be far too easy given the economic backdrop. So if the Fed raises rates 2 times or 3 times or, God forbid, 4 times, you still have a very, very supportive backdrop.
A really good final point, and I think that's where the conversation is going to gravitate towards over the next couple of months as well. What is actual tightening of monetary policy when you start to think about financial conditions? Hey, John, thank you, sir, and thanks for bearing with us through those technical difficulties. Jonathan Golub there of Credit Suisse. Your equity market, 48.16, let's call it 48.17 on the S&P, all-time highs. With more, here's Abby.
Well, John, one of the big questions of 2021 is one of the big questions of 2022, and that is, of course, whether or not value can finally outperform growth. Now, it did not happen in 2021, as you know, and over the last 5 years, growth has really dominated, both on an all-world basis and in the U.S., up 144 to 174% relative to value being up just 34 and 53% over the last 5 years. So really a big, big difference there. As for what could be ahead, the Bloomberg Money Manager survey shows that about 24% of the managers are leaning toward value in 2022, just 10% to growth in 2022, and then a very large slice, 25% to other, probably a mixture of various sectors. But the idea here is right now value looks good. Let's see whether or not the trend over the last 2 decades, though, John, can be broken, because over the last 2 decades, value has absolutely underperformed growth, really at an all-time low right now. But between 1980 and 2000, it was the other way around. So who knows? Maybe 2022 will be the beginning of value's resurgence.
Abby, great work. Thank you. I want to turn quickly back to Matt Miskin and Winnie Caesar. Thanks for the patience from both of you over the last 10 minutes. I hope you heard what Jonathan Golub had to say, because that's where I want to pick up on. And Matt, I want to begin with you. This idea that the Fed could take it to 1% this year. And in John's mind, it doesn't really matter what they do this year. They're still going to be providing accommodation for a market economy that is still incredibly hot. Can I get your reaction to that, Matt?
I would disagree. I think that you're going to see, if the Fed raises rates 4 times and even potentially starts reducing their balance sheet, that's going to remove liquidity pretty quickly. And that's going to potentially even invert the curve. I know that the 10-year is jumping here right now, but if growth does decelerate, and if, God forbid, we see a risk-off environment and stocks correct, I mean, that is normal, you could see the yield curve invert later this year, and that would actually be a pretty bad omen. And so we would be more careful, more thoughtful around allocating risk. I think the growth versus value discussion is really interesting. Financials right now are going to be the linchpin of that discussion in our view. Financials are one of the most momentum sectors, or the highest weight in the momentum indices, and yet earnings estimates are deeply negative. It's the only sector out of the 11 sectors to have negative earnings growth estimates into 2022. So there's a big divide on fundamental versus technical analysis there. That's our one to watch if you like value into next year. We're more cautious on it, and we see actually a bit more opportunities in the quality factor into next year.
So you'd be fading what we see on the screen right now. The financials up by 1.8% on the S&P 500, getting a tidy lift off the back, I guess, from what's happening in the bond market with yields higher. Winnie, Matt said something there about the inversion of the yield curve through this year. The Fed may be pushing it too far, the curve rolling over. Winnie, your view on the Treasury curve this year, what are you looking for?
I think that the Treasury curve has not hit kind of the flattening trend that a lot of people are expecting into inversion. I think that as we move through the course of the year, we start to see inflation decelerate a little bit, and the Fed gets its bearings around the longer-term trajectory for growth, that we're going to hear a little bit more cautious message around rate hiking. I don't think that the Fed is going to really aggressively hike rates just as inflation is coming down. So we don't think that the curve is going to flatten. If anything, we think that the other side of the trade should be the one that you're looking at, and that we think that you could see a little bit of steepening given that the front end has gotten a bit overdone when it comes to rate hiking expectations.
Interesting. It is very difficult to find consensus right now in the bond market, I have to say. Much more fascinating than the usual. Everyone's got the same thing to say about the same thing in the bond market. Woody, thank you. Woody Caesar, Matt Miskin there on this bond market, and the difference between them on whether one expects a flatter curve inversion, the other slightly steeper. This morning, yields are higher. Yesterday up 12 basis points on 10s, right now up 4 to 167 on a 10-year yield. On 2s, just short of 80 at 78, up a single basis point. We need to talk about oil too. Crude in focus with OPEC agreeing to boost production.
The question is, I think, basically more not if, but when we will exceed the peak we had prior to the pandemic, and that obviously will require all hands on deck.
That conversation up next.
offshoring.
This is Bloomberg's The Open. I'm Tqqq. Live in the principal room. Coming up, Sam Palmisano, the former IBM chairman and CEO. That's at 12:30 p.m. Eastern, 5:30 p.m. in London.
The OPEC Plus should just carry on with the planned 400,000 barrels per day. I think that's very much been on the cards for a while, especially after the data, and you were just talking about it, suggesting that Omicron should be or is milder, hospitals aren't getting overwhelmed, and that demand actually isn't taking as big a hit as some had feared. I think that's going to be the biggest change versus the December meeting.
OPEC Plus agreeing to boost production, lifting supply by 400,000 barrels a day in February. Oil rallying off the back of the meeting, with demand proving resilient against a new COVID variant. Bloomberg's Gillian Lee joins us now to discuss more. Gillian, let's just start with the meeting. Anything to see here? What was the big change?
There really wasn't. I mean, I think, you know, if you can call it a big change, the big change was the lack of dissension. It was a very quick meeting again. The last few have all been very quick. This one simply rubber-stamped what they had previously agreed back in July that they would do. There doesn't really seem to have been any disagreement among members over that. So very quick, very smooth.
I had this quote from Vanda Insights from Vandana Hari. I want to share it with you. I think OPEC's decision is a foregone conclusion. I imagine you agree based on what you just said. Omicron news and data will remain the major influence on oil sentiment. Gillian, can we talk about just demand, just the fundamentals here, supply, demand? Have we seen a demand drop-off in the last couple of months with this scare or not?
It seems as though we might have seen a bit of a drop-off. Certainly some of the mobility data that we look at, the high-frequency data on traffic congestion, on flight numbers, suggests that there has been a bit of a downturn over the holiday period. We're certainly seeing lockdowns in Chinese cities as they pursue their sort of zero COVID policy. So there may have been a bit of an easing. But what I think is really striking is that if you look at OPEC's forecasts for the first quarter, and you know that's what they use to make their decisions, while they are still forecasting a surplus, that surplus has shrunk to about 1.4 million barrels a day now, from their previous estimate of close to 2 million barrels a day. Some of that, of course, is due to a less rosy outlook for supply, as well as an easing back on some of the direst forecasts over what Omicron might do to demand.
Gillian, thank you. Gillian Lee of Bloomberg on this oil market. Thank you very much, sir. At 1.2% on Brent to 79.93, just short of 80 on WTI, 76.97, just short of 77 there at 1.14%. More work to do down in D.C. There always is. We're still waiting for the president's Fed picks. 3 seats on the board left to fill. Bloomberg reporting economist Philip Jefferson is likely to get one of those seats from this White House. For more, let's get back to trouble down in D.C. Bloomberg's Anne-Marie Horton. Anne-Marie, go on.
Glad to see you got the jacket back on, Jonathan. It's business time. So we are waiting for those Fed decisions, but we are reporting that, as you mentioned, one of those seats will go to Philip Jefferson. Now, this comes as the Fed has really faced a lot of criticism about the lack of diversity, especially when you look at some of the higher ranks on the Fed. So this would be able to mollify many people. And also the president said and promised that he would make sure that those 3 seats, there would be diversity. You remember that in November with the reappointment of Fed Chair Jay Powell and the elevation of Governor Brainard. Then we're waiting for the other 2. And this morning, Jonathan, Axios is reporting that Sarah Bloom Raskin does seem to be the top choice for the supervision position. Now, that is certainly one that is definitely key and a nod for the president to make sure he gets someone that the progressives agree on. And in December, we reported, when her name was thrown out there, we reported that Senator Elizabeth Warren would be supportive of her as taking on that position of the key banking regulation position at the Fed. So we're still waiting for the 3rd, but when it comes to timing, pure speculation, I think potentially tomorrow, because there's one open day on the public diary of the president that has no public events. So maybe in 24 hours we'll know.
Senator Warren getting a win, maybe, Anne-Marie, just on the policy front. What is it, the policy that this administration wants from this Federal Reserve? Have you got your hands around that? We can have this conversation about diversity. That's important. Of course it is. But what about policy? The policy of these officials? And isn't that why this pick of Bloom Raskin is so important here?
Well, for Bloom Raskin, it's certainly important when it comes to things like banking regulation. For Senator Elizabeth Warren, it's about making sure that this individual is going to have the consumers in mind and be tough on banks, as well as being open to making sure they include things like climate change when it comes to how it affects policy. But Jonathan, the real big question for the Fed going forward is how are they going to combat inflation at the same time as making sure that they have this broad, inclusive unemployment, which means rates staying at zero. This is the big question the Fed is facing.
Take a look at your screen right now. Just have a look. There you go. That was just to annoy you. Go away. Anne-Marie, good to see you.
I guess it's hot.
AMH, it is. Boiling. AMH, thank you very much. About 21 minutes into the session, equities positive a third of 1% on the S&P, up 16. Let's get you the sector price action. Here's Critty.
Well, good morning, John. And on the surface, it really does look like a broad rally, and it really looks like a recovery rally is what's leading. Energy, financials, those are going to be your leaders today. But look at your laggards. A lot of that defensive nature, real estate, utilities, they are at the bottom of the leaderboard. Healthcare really taking it on the chin. A lot of that has to do with biotech in particular. But what the sector story doesn't tell you, you can see with the individual movers. Ford, for example, is going to be your big mover today. 3% gains in just the first 21 minutes of trading. This coming after they're doubling their factory capacity for their electric F-150 Lightning to 150,000 trucks a year, and we'll start taking orders this week for the model. Here's why this is important, because when you look at automakers broadly, they've been under pressure for most of 2021 because of that semiconductor shortage. Then when you had Tesla kind of help those gains along with the EV boom, you saw the likes of Ford, GM trade higher. Now the rally is being led by Ford as they really kind of embrace that new EV revolution. And John, if today Ford is your big mover, tomorrow it's GM, because they are also coming out with their massive sales presentation and also revealing their latest products ahead of those orders as well.
Critty, looking forward to the coverage of that with you from the morning. Critty Gupta, of course, responsible for our chart of the day as well. Catch her at around 6:45, 7:45 Eastern Time on a daily basis on Bloomberg TV and on Bloomberg Radio. Into the bond market we go with 10-year yields higher by 4 basis points to about 167. A breakout yesterday of 12 basis points. The worst start to the year since 2009, according to our team here at Bloomberg. Your 2-year yield up a single basis point to 78. Coming up, the market moving events you need to be watching. That'll be next in our trading diary, as apparently I need to cool down with this. I still don't get this. If you have this on your desk, you'll have to let me know if these even work, and I'll try and plug it in and figure it out. From New York, this is Bloomberg. 25 minutes in, this is what an all-time high looks like in the equity market on the S&P, up 21, advancing 0.4% on the Russell, up about 0.6 on the Nasdaq, rolling over just 22, negative 0.14%. Get to the bond market. Here's a stat from Ed Bollenbrook and the team here at Bloomberg. We have not had back-to-back consecutive years of losses, 2 consecutive years of losses for the Treasury market since records began, going all the way back to 1974. We had one last year. Will we get one again this year? Right now, Treasury yields higher by 4 basis points to 167 on 10s, just short of 170 after starting the year, in and around 150 after ending it there, ending 2021 there anyway. Your 30-year yield up 4 basis points to 2.0678%, and where your 30-year is right now is where people expect the 10-year to be at the end of this year. The median forecast, the median estimate, just a little north of 2%, 2.04% to be precise. That's the price action. Let's get to the bond market. The story as follows in your trading diary, rather. It's so hot I can't think. ISM manufacturing numbers coming up at the top of the hour. The Fed's Neil Kashkari speaking at 11:30 Eastern, plus President Biden meeting with his COVID response team at 2 p.m. this afternoon. We get the FOMC minutes on Wednesday, a ton of Fed speak in between, and then on Friday, your main event. It is Payrolls Friday, just around the corner, something in and around 400K is your estimate. From New York City, this is Bloomberg.
Plus pounds of meat free.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, January 4th. Here are top market stories that we're following for you at this hour. Yen's feeling the heat. The currency starts the year off with a thud, sinking to a 5-year low. Treasury yields push higher. When do higher rates hurt stocks? And some CDC confusion here. The CDC approving a Pfizer booster at 5 months as the U.S. sets a new global daily record of cases on Monday. And Omicron's economic impact. We get one of the first reads on how the variant will hit the U.S. economy with the ISM survey that's dropping right now. We're going to get instant analysis with Tim Fiore, chairman of the ISM Business Survey Committee. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, Happy New Year. It's great to see you back.
Yeah, I'm happy to be back. It looks like a continuation of some of what we were watching at the back end of last year. What impact is Omicron going to have? Will it be inflationary? How big will the spike be? At the moment, though, I think the narrative is equities continue to brush it off. Fresh record highs being posted despite higher yield. There's a lot of data to get through, Alex.
Yep.
It is going to be interesting to see exactly what this data tells us about the trajectory, particularly about the labor market. And we get that jobs data dropping onto the screen right now. It is a little lighter than anticipated. Maybe we are starting to see people being pulled back into the labor market, or maybe actually companies are figuring out a way around the labor shortages they're focusing on right now. The number comes in at just north of 10 million, well, 10.5 million in terms of the openings that we have right now. The expectation was for something just north of 11 million, Alex. That was what the prior number looked like, which has been marginally revised higher.
All right, well, talking about data, let's get to that ISM. So ISM manufacturing coming in a bit light, 58.7. Prices paid, though, easing a bit here, 68.2. So that really missed expectations. New orders coming in around 60. ISM employment coming around 54. Also stronger, though, than estimates, and sequentially also stronger as well. So to Guy's point, are we seeing a labor force that is continuing to get employed? Let's get some more details here. Timothy Fiore, Institute for Supply Management's Manufacturing Business Survey Chair, is here with the instant analysis. Those are the numbers, Tim. Give us the read.
Okay, good morning. So December was really a month of transition for sure. In November, we indicated that there was some movement towards a better equilibrium between demand and supply. In December, for sure, we saw that. You saw a slight improvement on the employment number, and more importantly, you saw a pretty significant decline on the supplier delivery number, which indicates that suppliers are having a little bit easier of a time meeting factory demand. So December was a really good month. I mean, the attitude around shortages and lead times improved. About 10% of my comments indicated it was getting better. And on the same side, on the employment side, steady and slow progress. But on top of that, demand was really strong again, too.
So demand is still remaining elevated. Tim, good to see you. Happy New Year. What do you think the effect of Omicron is going to be, and how short-term do you think it's going to be?
Oh, my. Well, that's the real story. So we had a similar problem back in March and April, and in May and June when we saw the collapse of the manufacturing economy and then the climb out on that big sharp V. And what happens is that even if you're collecting information on a monthly basis, when things happen and change on a weekly basis, our numbers don't truly reflect that. So in the last week, there's been a lot of indications that there's a lot of absenteeism. People are testing positive, even though they went from a 10-day quarantine to a 5-day quarantine. That's going to be a lot of call-outs, a lot of no-shows, and it's probably going to lead towards more labor disruption in January and February. So here we are again. We had a similar thing in the August-September timeframe, and we're probably going to see the same thing again. Suppliers are going to struggle in January and February, maybe even into March. Demand will remain high, so that supplier delivery number will go up. The employment number will probably stay flat. So this is kind of the way of life, I think, for a period of time, because the variants are not going away.
So it feels like then, or do we ever hit peak supply chain issues, or are we just going to go in waves?
I think at the present time we're in waves. I was hoping that, the last couple of months that we were actually getting closer to that equilibrium. But based on everything I'm hearing in the last week, there's just a lot of 20% infection rates on the test side. Good thing is the hospitals are not overwhelmed yet. But a lot of kids are, in my local area here, they called off school because of bus driver shortages. So, I think we're going to see a lot of that, and that's going to lead towards absenteeism on the factory floor, not only for our panelist companies, but also for our suppliers.
Tim, how do you think it's going to be this year? How difficult is it going to be? You're kind of painting a picture of volatility in terms of the data that we're going to be getting. Are we just going to see kind of rolling factors, rolling from one part of the manufacturing sector to another, supply bottlenecks here, taking a while to impact supply bottlenecks over here. How clean is the data right now that you're seeing?
I think we're starting to develop a pretty strong pattern here. We've had several different variants come out, and we've had several different waves here on the supply input side. So I think we're going to see this continue for a period of time. The good thing is that every time you have a disruption in being able to meet demand, that demand is generally available to be satisfied in the future. So our customer inventory number, although it came up slightly to about 30, we're still well below where we want to be, 46. The backlog is still at a 63, 64 level, and new export orders are starting to grow a bit. So as long as demand stays strong, we can deal with all the rest of it. And the key is, again, labor. It has been labor for a year and a half. It will remain labor, and it probably will remain labor until we've really succeeded in battling this thing where it's a no-show.
Okay, let's talk about labor. So the labor index hit the highest level in about 8 months, rising to 54.2. Can you give us some insight as to how easy or difficult it is for manufacturers to hire workers and what they have to do to get them?
Okay, my hire-fire ratio on the comments was about 10 or something to 1. So we're still, everybody's really trying hard to hire. They're dealing with 30% turnover. 30% of my comments were turnover related. So they're still dealing with this gerbil wheel where they hire 2, they lose 1. The next week they hire 2, they lose 2. And that probably will continue as everybody chases wages. The comments, the opinion about month-to-month improvements flattened out in the month of December compared to November. So 7% of my comments in November indicated it was easier to hire in November versus October. The same comments came through in December. And you can bet now January that number is going to decline. So, labor continues to be the issue. And, we're going to have to battle our way through it in 2022. But, overall,
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
I'm finally the king of my own castle, but my castle has leaks and ants. So I use Thumbtack to find exterminators, electricians, roofers, and plumbers. Thumbtack has everyone for everything. I can check out reviews, prices, and book the pro I like on the app. So anytime something breaks or leaks or invades my house, I know exactly where to go. It's good to be king. Find your people. Download Thumbtack today.
Started having a sense of the importance of technology in expanding consciousness. BCI, it really is about that flesh-technology relationship.
What if we were to think about how human and machine could combine in a way where the car becomes my body and my mind becomes the brain that is operating the car?
Hyundai Motor, connecting art and technology. Super excited to open up my diploma from Southern New Hampshire University.
I'm nervous, I'm excited.
Okay, let's see it. Let's see it. Oh my gosh!
Jesus, she saw this. I did it. And it's here.
Next term starts soon. Visit snhu.edu.
1.6, nearly 1.7 rising Treasury yields reflecting rising expectations that the Fed will raise rates at least 3 times, possibly beginning in May. What impact is that going to have on equities? We're going to get some more insight tomorrow afternoon, of course, when we get the FOMC minutes from the last meeting. We're obviously going to look ahead to payrolls as well Friday. So this brings us on to our question of the day. When do higher rates start to hurt stocks? How high the yields have to go before TINA no longer applies? Let's talk about, first of all, the baseline for this. How high can yields go? Vincent Signorella, Bloomberg Global Macro Strategist, joining us now. Vince, that's the question for this year. The range over the last 3 months, 1.348 to 1.705. We're starting to butt up against the top end of that range. Do we push through it? And if so, how aggressively?
I think we definitely push through it. I think we see 2% in the 10-year before long, given the Fed is on course to hike 3 times. But I think the answer to your question, if you go back 50 years, and it took me 50 years to figure this one out, even when rates went astronomically high in the 70s and 80s in the United States, we didn't see necessarily a major sell-off in stocks. We just saw a very, very flat equity move. So it's potentially what we can see in 2022 are equities trading sideways, but not necessarily lower. However, the other side of the coin, when we saw the Fed ease dramatically, particularly after the financial crisis, and rates go down, you obviously saw stocks go to record highs, and we're still in that category. So in a sense, interest rates will affect, obviously, the bond markets, obviously the foreign exchange markets, but I think the equity markets, in a way, are, I don't want to use the word immune necessarily to higher rates because it does impact earnings, but it seems that with the higher rates, companies are eventually able to pass those costs along, and therefore the worst case basis is flat stocks. And as you look at the chart there, you can see from basically 75 to 2000, higher stocks, but in a moderation. And then after 2008, when the Fed and global central banks poured money into the markets, stocks went up dramatically.
What kind of move, Vince, would we have to see in yields to get real yields positive, and does that change the thesis?
It would change the thesis in some asset classes. I don't know particularly for stocks. It certainly would change the thesis for the dollar. You and I and Guy have had this conversation for months now, and you know my belief in that the dollar is going up this year by hook or crook, simply that we get higher yields and we get positive real yields in the U.S. and the dollar goes up, or some variant comes along and unfortunately crushes the economy again, and people go back into the dollar otherwise. I don't think it spells a good story for gold and certain commodities that the carry trade will hurt because of higher rates. But clearly I think the dollar's a winner, and I think stocks will meander, if nothing else, but they certainly are not going to collapse, I believe.
Vince, question from the audience, quick answer. Does he really expect, and the IB is referring to you here, 3 hikes this year? Is that what we're looking at here?
I think you could potentially see more than 3, yes.
Okay, well, that's
excellent.
quick.
Fast answer.
Fair enough. He'll do what we tell him is the thing. All right, Vince, thanks a lot.
I'm a good puppy.
Appreciate it. Vincent Signorella from Bloomberg, always great to see you. All right, let's get more insight into that question of the day. When do higher rates hurt stocks? Linda Dussel, Senior Equity Strategist at Federated Hermes, is with us. All right, Linda, what's your call? When do high rates hurt stocks?
Well, hi, good morning, and Happy New Year to everyone. Thanks for having me. Yeah, you know, what is important for stocks is that you don't hurt the price to earnings multiples. And if you go back to 1950, the price to earnings multiples tend to really start to get hit when inflation goes up over 4%. Now, that's not the 10-year bond yield necessarily, but they should be dovetailing. And I think what is interesting is that even as we've had very high inflation here, as we all know, the 10-year bond yield has been very, very well behaved. So we believe that our positive stock market view at Federated Hermes, which is above consensus for this year, will be fine as long as the 10-year bond yield doesn't go probably up much more than above 2.25. We're looking at 2.25% for this year. As a reflection of inflation.
Linda, is that when Tina doesn't work? Is kind of 2%, circa 2%, the point at which investors start going, there is an alternative. I can start putting money to work in bonds. 2% is enough for me in this current environment. Or given the inflationary back sort of drop that we have, does it need to be higher than 2%?
Well, you know, the bond market has been getting a lot of flows by really the aging baby boomer population really since 2009. They have suffered these very low interest rates and continue to put money into them. So if you were someone who believed, as we believe at Federated Hermes, that this year you're going to see global growth pick up fairly dramatically all around the world as these supply chains open up again, then you are going to see interest rates go up and you will lose money as a bond investor. So you'd kind of probably be shying away. And I really kind of like that Tina idea. I've actually heard one strategist on Wall Street speak of the guaranteed Tina, almost guaranteed to lose money in bonds. Not that we would be suggesting everybody sell all of their treasury bonds. It's definitely something that has to be part of a portfolio, but you can't make money in those. And so we think that means more money flows into stocks.
Well, Linda, let's get specific on the areas of stocks because today is a good example. Tech trading a little heavy as yields push higher versus, say, the S&P, and the cyclical value guys and energy and financials outperforming. Is that going to be the playbook for 2% yields or something else happen?
Yeah, well, of course, technology is a great sector. It permeates all the sectors of our economy, and it is a growth sector, but it shouldn't be expected to get hit very hard if we're right and the long-term bond yield stays reasonably, just behaves itself reasonably as it rises. But if you believe that the economy is nowhere near a recession, nobody says that it is near one, and interest rates are going to rise, historically, the best sectors to own in that environment were financials, energy, and industrials. And these are the cyclical sides of the stock market. They're clearly less expensive than the more growthy sides of the market. So that's where we would suggest an overweight continuing into this year.
Linda, it's the beginning of the year right now. My first day in the office since the start of 2022. A lot of people have got fresh money to put to work. Should they put that money to work now? We're here, we're fresh record highs. Or do you think there's going to be a series of entry points as volatility picks up that investors can access?
Well, yeah, you know, I think volatility and a volatile year coming up is probably an extremely consensus call that is being made right now. You should expect volatility to go up because last year you only had 5% pullback. That is I just read this very recently, the ninth smallest intra-year pullback since 1950. It was a very low volatility year last year. Historically, you should expect more volatility the following year, 22. You should also expect more volatility in a midterm election year. And I am not a fan of trying to call the market in terms of timing. We are bullish on earnings this year. We believe earnings and the market will advance about 10% this year. If you believe that, you would simply dollar cost average as your money comes in. You would not try to time the inevitable 10% pullback, which we probably will get. But when would we get that? If we're going to get it, I think would probably be a good idea to say, you can sell in May and go away if you want to go ahead and do that. Because historically the market is volatile leading up to the midterms, and it doesn't seem to matter what the result of the midterms are, but then the market tends to rally after that. So we should finish the year well if we have to have some intra-year volatility.
Lynn, it's been great to catch up so early on in the year, to set the stage, to look forward to 2022. Thanks very much for joining us. We look forward to talking to you throughout the year. Linda Dussel of Federated Hermes, thank you very much indeed. What are we going to talk about next? OPEC Plus agreeing to proceed with its next 400,000 barrel a day hike. Oil's ticking higher. Are they going to be able to deliver those 400,000 barrels? How much spare capacity is there out there? We'll figure that question out next. This is Bloomberg. So oil tracking higher, up by around 1.5% on either side of the Atlantic. OPEC Plus, led by Saudi Arabia and Russia, of course, agreeing to revive some of the cartel's halted output. They are going to proceed, the cartel is going to proceed with a 400,000 barrel a day hike. That's going to begin February. Julian Lee, Bloomberg oil strategist, joining us now. Julian, give us your takeaway from this. This all looked fairly straightforward. It would therefore appear as if OPEC's got a much higher degree of certainty as to what the outlook looks like.
Yeah, they certainly seemed much more comfortable making an output increase this time than they did last time. There was none of last month's dramatic decision to keep the meeting in session. That, of course, winding that meeting up was the first thing they had to do when they got together today. But this was a very smooth meeting, very quick. There doesn't appear to have been any drama. There doesn't appear to have been any dissenting voices. So they've gone ahead and agreed that they will add another 400,000 barrels a day at the start of February.
Hey, Julian, can they add the 400,000 barrels a day?
Well, that's the big question, and recent experience says no, they can't. We saw that they were, the most recent month that they've done an assessment of is November. We saw that they were saying that overall compliance in November was 117%. That translates into a shortfall against their overall target of about 720,000 barrels a day. And they are struggling to add all of the production that they say they will. There are some countries, Angola, Malaysia, perhaps at the top of that list, but a list that's also growing in some people's minds to include some of the really big players like Russia and possibly Kuwait that are struggling to add as much as they say they will.
Okay, well that takes us on to the next question, which is how much spare capacity does OPEC really have as we go into 2022? How much spare capacity does OPEC have throughout 2022? And are we going to get to the point this year when it runs out of that spare capacity?
I think this is a question that as the year goes on, if we see demand increasing in the way that people think it will this year, perhaps surpassing the pre-pandemic peak. Towards the end of the year, we may well see a point where spare capacity becomes a real issue. We've seen Russian oil producers saying that they will have used all their spare capacity by April. We're seeing other countries, some of the fairly big producers I've already mentioned, Kuwait, but if you add in, Nigeria, which is really struggling, Angola probably hasn't got a lot of room for growth. There's a whole raft of them that are really running up against what people see as buffers. Now, there is spare capacity elsewhere. There's certainly spare capacity in the United Arab Emirates and in Saudi Arabia. But what we haven't yet seen from the OPEC Plus group is any discussion of those members that can making up for the shortfall of those members that can't meet their targets. The discussion is still, believe it or not, about compensation with deeper cuts for past overproduction.
And that's interesting versus supplementing those that can't meet it right now. Bloomberg's Julian Lee, thanks so much. I'm also curious to see what President Biden does with this information. Is this going to be enough to kind of calm down the inflation narrative? I don't know about that one when it comes to gasoline. All right, well, coming up, U.S. COVID cases topped the $1 million mark for the first time. How effective is testing? Lauren Sauer will be joining us, University of Nebraska. This is Bloomberg.
Or should I do the whole thing?
We are 1 hour into the U.S. trading session on this Tuesday. Bloomberg's Abigail Doolittle is here looking at the movers. Tech finally under some pressure from those higher yields.
Yeah, tech is under big pressure, and it's a really interesting divergence, Alex, because of course one of the big questions last year, growth or value. Today it's all about value. You can see the S&P 500 higher off of its highs, but nonetheless another all-time high. The Dow outperforming some of those cyclical sectors in there in stocks. But to Alex's point, take a look at the NASDAQ 100, down 0.9%, earlier down 1%. The China Tech Index down 4.5%. It has everything to do with exactly what you said, Alex, rising yields. If we take a look at the 10-year yield over the last 2 days, this is a tremendous backup in such a short period of time. In 2 days, the 10-year yield has backed up 15 basis points at 166, its highest level since November 23 of 2021. And this seems to reflect the Fed's more hawkish stance made in December, but there's been some wobbliness, uncertainty, but the trend has been higher all along, and it seems as though we're going to continue to see this back up, at least right now. Relative to what sectors are doing well because of the cyclical nature, well, take a look at energy, up 3.3%. Oil, of course, is higher. The financials getting a nice bid once again, up 2.4%. The industrials and materials. So today is all about that cyclical trade. And then finally, let's take a look at a big tech stock, Apple. I'm not quite sure where it's going to be. Let's see. 182.49, so very, very close to that $3 trillion mark. Not quite there. Briefly above it yesterday, as you know, Guy. We'll be watching it all day long.
Absolutely. Some of the other data we're going to be watching quite carefully is going to be the car sales data, which is going to start to trickle out over the next hour or so. We're starting to get numbers now through from Toyota. I think it's interesting to kind of dig into the year-on-year and the December numbers, because we saw that kind of spike, which is just generally fading, Alex, across a number of auto manufacturers. So the 2021 data, 2.33 million. So that's up 10%, but it's very bumpy data. So the December number down by 30.2%. The chip story continues to wreak havoc. The automakers are getting better at it, but nevertheless, huge volatility in terms of what we're seeing from the auto sector on both sides of the Atlantic, Alex, I have to say.
Yeah, it'd be interesting to see sort of what the prices were paid for some of those vehicles, too. All right, let's get to COVID here. Just moments ago, Maryland Governor Larry Hogan declared a state of emergency over the recent COVID surge in his state, and the U.S. topped 1 million COVID cases for the first time on Monday. A big part of getting the cases under control comes down to testing. So joining us now, Lauren Sauer, University of Nebraska Medical Center Associate Professor. She is the Director of the Special Pathogens Research Network. Professor, really good to talk to you. First of all, do the at-home rapid test or even the rapid test you get in any clinic, do they work? Are they accurate? Should we be using them?
We should definitely be using them. I think that one of the biggest challenges with those at-home tests right now is actually being able to get them, especially in places where COVID cases are surging. And we're seeing a lot of asymptomatic people buying them up to make sure that they can travel safely and go to their gatherings for the holidays. There's a little bit of evidence that they may be slightly less sensitive when it comes to the Omicron variant. So, you know, if you're using those at-home tests and you're symptomatic and you get a negative, you should follow it up with a PCR, and you should definitely still stay at home until your symptoms resolve. So they still work. They're still really effective, and they're still useful for the goal of keeping people safe. But we want to follow those up and make sure that we follow them up with that PCR test.
Laura, what about the other way around? For those people that have had COVID over the last few weeks and are looking to go back to work, PCR tests can pick up strains of the variant for weeks and weeks and weeks. What is the best way of getting back to work? Is it via the lateral flow tests, or is it via using a PCR?
Yeah, so the best way to get back to work is once you're asymptomatic after you've been sick. So after you've had that positive test or after you've developed symptoms, and then you start your countdown. In this U.S. now, the CDC recommends 5 days. My preference is for a bit longer, actually. But once you're asymptomatic, you can start that clock. And so PCR tests may remain positive for quite some time, like you mentioned, after that initial positive test. And the lateral flows are not as reliable as indicating when you can go back. But a negative test will say you are not currently contagious. And so it is a little bit of a balance, but you really want to follow the recommendations around